As of Thursday, October 2, 2025 at 11:48 a.m. Eastern Time, Opendoor Technologies, trading under the ticker OPEN, is priced at approximately $8.04, reflecting a slight intraday dip of about 0.25%. Now, on the surface, a fractional percentage move on a single-digit stock might seem like statistical noise, the kind of daily fluctuation most would dismiss. However, what this seemingly quiet price action conceals is a furious battle raging beneath the surface, a conflict between a deeply entrenched market narrative and a rapidly shifting operational reality. The common perception, the story that has defined Opendoor for years, is that of the high-flying, cash-burning iBuyer, a company whose fate is inextricably tied to the volatile swings of the housing market. The expectation is simple. When interest rates are high and home sales slow, Opendoor should suffer. When the market is hot, Opendoor should thrive. But this simplistic view is becoming increasingly obsolete, and the subtle movements in its stock are the early tremors of a much larger seismic shift that most investors have yet to appreciate. The real story isn't just about buying and selling homes anymore, it's about a fundamental transformation in the company's DNA, moving from a capital-intensive behemoth to a more agile, platform-centric model. The prevailing expectation has been that, as a primary player in the iBuying space, Opendoor's balance sheet is perpetually at the mercy of housing market fluctuations. The model seems straightforward: buy homes with cash, perform light renovations, and sell them for a small profit. This business is inherently risky, requiring immense capital and accurate pricing algorithms to avoid catastrophic losses, especially in a downturn. We saw the dangers of this model play out in the recent past, where misjudging the market led to significant inventory write-downs and substantial losses, reinforcing the narrative that Opendoor is a high beta bet on housing. Many looking at the stock through their Fidelity Investments or Robinhood app see this history and assume the risk profile remains unchanged. They see a company that must hold billions in real estate assets, making it vulnerable to every percentage point shift in mortgage rates and every negative headline about consumer confidence. This has led to a deeply divided analyst community, with ratings scattered from strong buy to strong sell, reflecting a profound uncertainty about the viability of the core business. The expectation is one of cyclicality and immense risk. But the reality of Opendoor in late 2025 is far more nuanced and strategically complex. While the iBuying segment remains a core component, the company has been aggressively diversifying its revenue streams and de-risking its balance sheet in ways the market has been slow to price in. The evolution is towards a marketplace model, an asset-light approach where Opendoor facilitates transactions without always taking on the inventory risk itself. This involves connecting sellers with a network of institutional buyers and offering a suite of adjacent services like title, escrow, and financing through Opendoor home loans. This strategic pivot is a direct response to the inherent vulnerabilities of the pure iBuying model. It's a move from being just a house flipper to becoming a comprehensive real estate platform. Think of it less as a company that simply owns and sells houses, and more as a technology provider that powers the entire transaction ecosystem. This is a critical distinction that many investors, whether they're using SoFi Invest for a robo-advisor approach or are more active traders on platforms like Interactive Brokers, seem to be missing. The recent financial reports, while still showing losses, hint at this underlying transition. For instance, the company's ability to beat revenue estimates in the second quarter was a positive sign, but the cautious guidance for the third quarter, projecting a significant sequential decline in revenue, spooked many. However, this guidance might not be a signal of weakness in the traditional sense, but rather a reflection of this strategic shift away from holding a massive inventory of homes and towards higher-margin, fee-based services. Looking at the recent stock movement, the volatility is palpable. The stock has seen incredible swings over the past year, with a 52-week range stretching from just over 50 cents to nearly $11. This isn't the behavior of a stable, predictable company. It's the signature of a stock in the midst of a major re-rating, where the market is struggling to reconcile the old narrative with the emerging reality. Trading volumes have been immense, often exceeding 150 million shares in a single day, indicating that large institutional players are actively adjusting their positions. This high volume isn't just retail speculation, it's a sign that significant capital is flowing in and out of the stock as different theses are tested. The institutional ownership breakdown is particularly revealing, with nearly half the company held by institutions like Vanguard and BlackRock. While this lends a degree of credibility, it also means that shifts in their sentiment can have an outsized impact on the stock price. Recent downgrades from analysts at firms like Keefe, Bruyette & Woods and Citigroup have added to the pressure, citing concerns over profitability and the challenging macroeconomic environment. However, it's crucial to understand that these analyses are often based on the traditional iBuying model and may not fully account for this strategic pivot. For the individual using an online investment platform, this creates a confusing picture. The challenge is to see past the headline noise and understand the fundamental changes happening within the company. At its core, Opendoor's business model was designed to solve a major pain point in the residential real estate market: the uncertainty, complexity, and lengthy timeline of a traditional home sale. By providing a quick, all-cash offer, Opendoor offers sellers certainty and convenience. The process is powered by a sophisticated data analytics engine that assesses a home's value based on a vast array of market data points. Once an offer is accepted, Opendoor takes ownership of the home, handles any necessary repairs, and then lists it for sale on the open market. The revenue is generated from a service fee, typically around 5%, and any appreciation in the home's value upon resale. This is the iBuying model in its purest form. However, the company has expanded far beyond this initial concept. The introduction of Opendoor Exclusives, a marketplace for off-market properties, and the integration of mortgage and title services are clear indicators of the company's ambition to build a one-stop shop for real estate transactions. This is a far more scalable and less capital-intensive model than simply buying and selling homes. It allows the company to participate in a much larger share of the real estate market without a commensurate increase in risk. This is the part of the story that doesn't get enough attention. People focused on the number of homes sold each quarter are missing the growth in these ancillary high-margin services. Before we continue, I want to hear from you. Comment below and let me know if you believe the future of real estate is in these all-in-one digital platforms, or if the traditional agent model will always dominate. Looking ahead, the future for Opendoor is a tale of two competing forces: the macroeconomic headwinds of the housing market and the internal tailwinds of its strategic transformation. The external environment remains challenging. While the Federal Reserve has initiated some modest rate cuts, mortgage rates are still elevated, creating an affordability crisis for many potential buyers. This lock-in effect, where existing homeowners are reluctant to sell and give up their low-rate mortgages, continues to constrain housing supply. Inflationary pressures, though easing, could keep rates higher for longer, further dampening activity. This is the reality that Opendoor must operate in, and it's a significant headwind for any company tied to the housing market. The long-term period of high rates and low transaction volume will undoubtedly test the resilience of its business model, regardless of its strategic pivots. This is the primary risk that investors in Tesla stock and Apple stock, who are accustomed to tech-driven growth stories, need to appreciate when looking at a company so tied to a physical asset class. However, the internal catalysts could be powerful enough to overcome these external pressures. The continued build-out of its asset-light marketplace is the most significant opportunity. If Opendoor can successfully transition from being the primary buyer to becoming the primary platform, it could unlock a far more attractive financial profile, characterized by higher margins, lower capital requirements, and more predictable revenue streams. The potential for growth in its ancillary services is also substantial. As it captures more of the transaction, from mortgage to title, it increases the revenue per customer and builds a stickier ecosystem. The key will be execution. Can the company scale these new offerings effectively while maintaining a high level of customer satisfaction? Can its technology continue to provide a competitive edge in pricing and service delivery? Success will also depend on its ability to manage its remaining iBuying inventory effectively, avoiding the costly mistakes of the past. Platforms like Schwab Intelligent Portfolios are built on diversification and risk management, principles that Opendoor is now trying to embed into its own strategic strategy. Self-investing requires a deep understanding of these shifts, looking beyond the quarterly home sales figures to the underlying changes in the business.